In our earlier video on financial performance, we have seen that the fundamental objective of business is to maximize shareholder wealth, and this can be done through sustainable business cash flows. That's where financial performance comes in. And the other part is, of course, well-managed risk. Now, in this video, we are going to look at risk and how risk is compensated for using the required rate of return approach. It's a basic rule of life that higher the risk, higher the required return. So let us talk about risk, required returns, or as we call it from the company's point of view, the cost of capital. There are two approaches to cost of capital. We have a risk-based approach, which is done using the capital asset pricing model. And basically the concept is higher risk should be compensated for higher returns. So we will see what we mean by risk under the capital asset pricing model. And the second one is, of course, the income approach, where listed companies look at what kind of returns shareholders or current investors are working with on the stock market. So that's an indication, or that's a signal to the company that investors are happy to get those returns that they're getting on the market. And that's why they're buying the company's shares. So let's look at the risk-based approach first. This approach uses a model called the capital asset pricing model. The parameters of this model are basically that listed companies want to maximize shareholder value. Therefore, they have to, among other things, try to reduce risk. One way of reducing risk is to diversify. But when you diversify, you only reduce the individual or unique risk of your business. That's also sometimes called alpha risk, the diversifiable risk of your business. And then there is that risk, which is the market risk. Now, market risk is not diversifiable because it's in the market. And individual companies cannot control what's going on in the business, in the market. So if total risk is measured by standard deviation, that's the blue circle here, and part of total risk is market risk, we need to be able to diversify the alpha risk, that is the diversifiable risk, so that we can minimize it or bring it close to zero. Then the only risk that the company will need to compensate investors for is market risk. So this will look something like this. A company that has fully diversified its portfolio, asset portfolio, will have very little alpha risk left. Investors will only require compensation for market risk, which is measured using beta value. And the capital asset pricing model provides a market risk adjusted required returns for companies whose risk profile is mainly comprising market risk only. So therefore, the risk-return trade-off now becomes higher the market risk, which is measured by beta value, higher would be the required return. Before we move on, let us understand what we mean by returns on the stock market. Market returns in Malaysia are usually measured using the Financial Times Bursa Malaysia Kuala Lumpur Composite Index. Returns are simple enough when it comes to the composite index. We just look at the index at the start minus the index at the index at the end minus the index at the start of a certain time period, divide by the index at the start, because we want to see the change from the start to the end. For example, the Kuala Lumpur Composite Index in 2016 was about 1400, and at the start of this year 2017 it was about 1700. So if we were to just round it up to these numbers, we could say that the returns provided by the market index during the year 2016 was 21.43%. That is 1700 minus 1400 divided by 1400. To take another example, if an index at the start of a period is say 1677, index at the end is 1741, then the market returns would be 3.82%. Is it possible to have negative returns during any period? Of course it is. When the stock markets go down, those are time periods of negative returns. We looked at the shares of Maybank some time ago, and the current price was 929. The price a year ago from that point was 769. So the basic return provided by Maybank was 20.81% for anyone who held Maybank shares for the 1 year period under consideration. And then we find that the dividend yield that was computed during that time period was 5.92%. Therefore, Maybank provided total returns of 26.73%. From this, I think you should see that when we talk about market returns, we are talking about how the composite index changed over 1 year. But when we are talking about individual shares and returns on individual shares, we are talking about the change in price, that's the capital gain or loss, and added or adjusted by any dividend yield that may have been provided by that share. So how do we use this information to get required returns? This is actually done using the SML equation or the securities market line equation. SML stands for securities market line. And of course, securities market line is simply another word for stock market line. And the formula for required return is the risk-free return, RF, plus beta multiplied by market premium for risk, where market premium for risk is the market returns as measured by the changes in composite index minus the risk-free return. The logic of this model is pretty good, which is basically this, that if you can invest in the stock market without any risk, and that's basically investment in government bonds and stuff like that, which are considered to be risk-free, especially short-dated government bonds, then every security that is listed on the stock market must provide returns of at least RF, the risk-free return, plus a compensation for the risk in that security. So now, if we had two securities, stock A and B, and both are electric utility companies, you will find that stock A is worthwhile because the required returns based on their risk level, which is just below beta 1, is this blue dot here. Stock A is desirable because it gives returns higher than the required return. Stock B would not be a desirable investment because it gives returns below the blue dot. So the securities market line is a good convenient way of listing down the beta value of a specific security and then reading off what is the expected return or required return. The general return on the market for any security that has beta 1 would be the market return. RM here minus RF would represent the market premium for risk. So if a company had beta 1, it would have the same market premium for risk. But if a company had beta less than 1, then it would take a lesser proportion of this market premium for risk. In the same way, if the beta value was greater than 1, then it would take a greater proportion of this market premium for risk. So the concept of CAPM is that returns must compensate for market risk. Market risk is measured by beta, and if your beta value is greater than 1, you must compensate for the risk-free return plus whatever is the market premium for risk. Under the income-based approach, which is also sometimes called the weighted average cost of capital, truth be told, the final computation of cost of capital or required returns is always a weighted average of returns from equity and returns from bonds. So, but this is the original model or older model, so it's also called WACC or weighted average cost of capital. where KE are simply the returns provided on the ordinary shares. If we use the basic model, then returns on equity or the cost of equity to the company is simply the dividend yield. That's dividend divided by current price. But of course, for the purpose of financial management, we need something a bit more sophisticated. So we have an indirect method of taking capital gains into account by considering the potential for these dividends to grow. Now, if we take the model with growth adjustment, then this model becomes KE is equal to next year's dividend D1 divided by current price plus the growth rate, average annual growth rate in dividends. Yeah, so you see D1 is next year's dividend, G is the expected growth rate, where in an exam question you do not know what is the next year's dividend, you may actually use current dividend to estimate next year's dividend. So D0, 1 plus G, is an estimate of what next year's dividend would be. Now, this would be therefore a growth adjusted dividend yield. The growth adjusted dividend yield is used as the cost of equity to the company, hence the term KE. When it comes to bonds and debentures, the KD, the cost of debt, is usually just the internal rate of return of debenture cash flows adjusted for the tax benefit that we have when we pay interest. And it's applicable to all bonds and debentures where the redemption date is known. Where the redemption date is not known, or debentures are stated to be irredeemable, or the redemption date is probably more than 10 years away, then the formula becomes very simple. Cost of debt, or the interest yield if you like, is simply the interest income at coupon rate divided by current price adjusted for the tax benefit at 1 minus the tax rate. So once we have got the KE, the cost of equity, and the cost of debt, we can actually compute the weighted average of these costs. Cost of capital is simply the weighted average between cost of equity and the cost of debt net of tax benefit of paying interest. How do you actually do this? Well, there's a step-by-step procedure for this, which I have listed here for you. Firstly, determine the total market value of equity. Secondly, determine the total market value of bonds. If you add the two up, that will give you the total market value of all listed securities of the company. Use this data to work out the proportion of equity, which is E divided by V, and the proportion of debt, which is D over V. Then calculate cost of equity either using CAPM or weighted average cost of capital. Calculate cost of debt, net of tax benefit. Once that is done, you can substitute this in the formula for cost of capital, where K0, the cost of capital, is KE, the cost of equity, multiplied by the proportionate value of equity, plus the cost of debt, net of its tax benefit, multiplied by the proportionate market value of debt. And Bob's your uncle. That's all you need to do to calculate cost of capital.